It is January 25th, 2026, and while the world sleeps, a silent mechanism has been triggered in the heart of the global financial system. The banks know it, the algorithms have detected it, but no one is telling you. In exactly 6 days, the data goes dark, the markets fly blind, and when the Federal Reserve realizes what has happened, it will already be too late. This is not a prediction. This is a countdown. Silver just crossed $100, but $500 is not the ceiling. It is the floor of what comes next. The liquidity freeze has begun, and the exit doors are closing. Ladies and gentlemen, welcome to John Analyst, where we decode the signals the institutions hope you will ignore. Now, before we continue, if you have spent decades building wealth, if you understand that real information is not free, then do yourself a favor. Hit that subscribe button right now. Think of it as joining a private briefing room, not a circus. We do not entertain here. We inform. And one more thing, drop a comment below and tell us, where in the world are you watching this from? Because what we are about to reveal affects every market, every currency, every business owner on this planet. Now, let us begin. There's a word that Wall Street uses in private, a word that never appears in press releases or CNBC segments, but when it is whispered in the trading floors of Goldman Sachs or BlackRock, careers end, portfolios collapse, empires crumble. That word is illiquidity. It is January 2026, and the global financial system is standing on a sheet of ice so thin that even the central bankers can hear it cracking beneath their feet. But to understand what is coming, we must first understand what liquidity actually is. Most people think liquidity means money, cash sitting in a bank account, but that is not liquidity. Liquidity is the ability to convert an asset into cash instantly without losing value. It is the oil in the engine of capitalism. Without it, the machine seizes. Think of the financial system as a vast network of pipes, trillions of dollars flowing through them every single day. From banks to hedge funds, from corporations to governments, from New York to London to Tokyo, this flow never stops. It cannot stop. Because the moment it does, the entire structure begins to collapse under its own weight. Now, imagine someone turning off the valve. Not slowly, but all at once. That is what a liquidity freeze looks like. We have seen this before. September 2008. Lehman Brothers collapsed on a Monday morning, not because it was bankrupt, but because no one would lend to it overnight. The interbank lending market froze. Banks stopped trusting each other, and within 72 hours, the global financial system was on the edge of total disintegration. The Federal Reserve had to inject $700 billion just to keep the lights on. But here is what most people do not understand. The 2008 crisis happened when U.S. debt was $10 trillion, or when inflation was dormant, when the world was still functioning under a stable geopolitical order. Today, U.S. debt is $36 trillion. Inflation is structurally embedded in the system, and the geopolitical order is fracturing in real time. The margin for error has vanished. So, what are the warning signs? Let us examine the technical indicators that institutional risk managers are watching right now. First, the secured overnight financing rate. So far, this is the cost of borrowing cash overnight using U.S. Treasury bonds as collateral. In a healthy market, this rate should mirror the Federal Reserve's official rate, but it does not. SOFR has been creeping higher. Decoupling from the Fed's target. This means banks are becoming reluctant to lend even against the safest collateral on earth. They are hoarding cash. They are preparing for something. Second, the reverse repo facility at the Federal Reserve. This is where banks park their excess cash when they do not trust the system. In 2022, this facility held over $2 trillion today. It is nearly empty. The cash cushion has evaporated. There is no buffer left. Third, Treasury auction dynamics. When the U.S. government sells bonds to fund its operations, the auctions should be oversubscribed. Investors should be fighting to buy them. But recent auctions have shown troubling patterns. Weak demand, higher yields required to attract buyers, foreign central banks reducing their holdings. This is not normal. This is the bond market sending a distress signal. Fourth, corporate credit spreads. This measures the difference between what the government pays to borrow versus what corporations pay. When this spread widens, it means lenders are demanding a higher premium for risk. Right now, these spreads are widening across investment grade and high yield debt. Translation: the cost of borrowing for businesses is rising fast. For entrepreneurs and business owners watching this, this is not abstract theory. This directly impacts your ability to finance operations, to expand, to refinance existing debt. When liquidity dries up, it does not just hurt Wall Street, it suffocates Main Street. Now, combine all of these signals: SOFR rising, reverse repo depleted, Treasury auctions weakening, credit spreads widening, and you begin to see the outline of something catastrophic. The pipes are clogging, the flow is slowing, And the institutions that depend on that flow are starting to panic. But here's the critical question. What could trigger the freeze? What event could cause the entire system to seize up simultaneously? The answer lies not in economics, but in politics. Because in 6 days, the United States government may shut down. And when it does, the data that the financial system depends on to function will go dark. The Federal Reserve will be flying blind. The algorithms will have no inputs. And the machine will start to fail. We need to examine the catalyst. We need to understand why this shutdown is different from every other political theater we have witnessed. Because this time, the consequences are not symbolic, they are systemic. There's a scene in every disaster movie. The moment when the instruments fail, the pilot looks down at the dashboard, and every gauge reads 0. No altitude, no speed, no fuel reading. The plane is still flying, but the pilot has no idea where, or for how long. That is precisely what is about to happen to the Federal Reserve, and it happens in exactly 6 days. Let us be very clear about something. The United States government has shut down before. In 2018, it lasted 35 days. In 2013, 16 days. In 1995, 21 days. Each time, the politicians screamed, the media panicked, national parks closed, and then a deal was struck. Money was printed, everyone went back to work. Life continued. So why is this different? Why are the algorithms at JP Morgan and BlackRock recalibrating their risk models right now? Because this time, the shutdown does not just stop paychecks. It stops information. Modern financial markets do not run on intuition. They do not run on human judgment. They run on data. Constant, precise, real-time data. Every interest rate decision, every bond trade, every stock price is calculated based on a stream of economic indicators. The Consumer Price Index, CPI, tells us if inflation is accelerating or cooling. The Non-Farm Payrolls Report tells us if the labor market is strong or cracking. The Personal Consumption Expenditures Index, PCE, tells us how consumers are actually spending. These reports are released on strict schedules, and the entire global financial system calibrates itself around them. But here is what most people do not realize. These reports are produced by government agencies. The Bureau of Labor Statistics, BLS, the Bureau of Economic Analysis, BEA, the Census Bureau. And when the government shuts down, these agencies close. The employees are furloughed. The websites go dark. The reports are not published. The data disappears. Now imagine you are Jerome Powell, chairman of the Federal Reserve. Your mandate is to control inflation and maintain employment. But to do that, you need to know what inflation and employment actually are. You need the numbers. You need the data. But suddenly, there is no data. The CPI report scheduled for February 12th, canceled. The jobs report for February 7th, delayed indefinitely. The GDP revision, postponed. You're holding the steering wheel of a $28 trillion economy, and someone just turned off your headlights. What do? This is not a theoretical problem. In March 2020, when the pandemic hit, the Fed had data. They knew unemployment was spiking. They knew consumption was collapsing, so they acted with precision. But this time, they will have nothing. No employment numbers, no inflation data, no consumer spending metrics. They will be operating on assumptions, on guesses, on hope. And central banks do not function on hope. Here is where it gets dangerous. When a central bank loses its instruments, when it cannot measure the temperature of the economy, it defaults to one primal instinct, caution through liquidity. It floods the system with money, just in case. Because the one thing a central bank fears more than inflation is deflation. More specifically, a deflationary spiral caused by a credit freeze. If they do nothing, and the system seizes up, it is 2008 all over again. So they will choose inflation over instability. They will print. They will inject reserves. They will open the liquidity spigots wide. Not because they want to, but because they cannot afford to be wrong. Now, the sophisticated money knows this. The sovereign wealth funds in Abu Dhabi, the family offices in Singapore, the hedge funds in Greenwich, Connecticut, they are not waiting for the shutdown to happen. They are positioning now. They are buying the assets that benefit from central bank panic. They are buying gold. They are buying silver. They are exiting the dollar before the dilution begins. This is why silver crossed $100 while most people were watching football games. This is why gold hit new all-time highs on a Sunday night. The smart money is not reacting to the crisis. They are front-running the response. But there is another dimension to this, a dimension that has turned this budget deadlock into something far more dangerous. Because while Washington argues about numbers on a spreadsheet, something has ignited in the streets of America, something that has made political compromise impossible, In Minneapolis, federal agents conducted an operation, and a healthcare worker, a nurse, was killed. Not a suspect, not a criminal. A woman who spent her career saving lives, shot while walking home from a 12-hour shift. The video went viral in minutes. The protests began within hours. And now, the Senate Democrats have drawn a line. They are saying, we will not fund the agencies that pull the trigger. The Republicans are saying, we will not defund the enforcement we promised our voters. This is no longer about fiscal policy. This is about justice, morality, rage. And when politics becomes emotional, when compromise means betrayal of your base, deals do not get made. The government shuts down, not because anyone wants it to, but because no one can afford to back down. So here is what we are facing. A government shutdown that eliminates economic data. A Federal Reserve forced to fly blind. A central bank that will default to printing money. And a political system too polarized to negotiate. This is the convergence. Political paralysis meets fiscal reality meets social unrest. And standing in the middle of this perfect storm is a metal that has been quietly climbing for months. Silver. We need to understand why silver is moving the way it is. We need to examine the velocity, because the speed at which this asset is rising is telling us something the headlines are not. There is a principle in physics. When an object accelerates beyond a certain threshold, it enters a phase where resistance no longer matters. A rocket leaving Earth's atmosphere, a satellite achieving orbital velocity. At that point, gravity cannot pull it back. It has escaped. Right now, silver is achieving escape velocity, and most investors have no idea what that means. Let us talk about something the financial media refuses to discuss. Speed, not price, not valuation. Speed. Because in markets, velocity reveals intent. A slow climb tells you institutions are accumulating carefully. A sharp spike tells you algorithms are reacting to news. But an acceleration, an exponential curve, that tells you something far more dangerous. It tells you the buyers are not trading anymore. They are fleeing. There is a metric we track. It is called time to travel. It measures how many days it takes for silver to move $10 in price. This is not a standard indicator you will find on Bloomberg or Reuters, but it is one of the most revealing tools for understanding market psychology. Let us walk through the data. When silver moved from $20 to $30, it took 145 days, 5 months of grinding, battling resistance, testing patience. Every dollar gained was a war. The banks were shorting. The algorithms were selling every rally. Retail investors were exhausted. It was a slog, but the metal moved slowly, steadily. Then the move from $40 to $50, that took 39 days. Suddenly, the pace changed. The resistance weakened. The sellers were tiring. The momentum was building. But it was still rational, still within normal market behavior. Investors could still calculate risk. Traders could still set stop losses. It was fast, but not unusual. Now, look at what happened in the last 2 weeks. The move from $70 to $80, 6 days, not 6 weeks, 6 days. The market did not pause, it did not consolidate, it did not give bears a chance to reload, it simply broke through. And then the move from $90 to $100, the most psychologically significant barrier in silver's modern history, a level that should have triggered massive profit taking, a level that should have stopped the rally cold. 10 days to cross the threshold that everyone said was impossible. Do you see the pattern? 145 days, 39 days, 6 days, 10 days. This is not a linear progression. This is exponential decay and resistance. This is what happens when sellers disappear, when algorithmic suppression fails, when the paper market loses control to the physical market. Here is what that means in practical terms. At $20, silver was an investment thesis. Investors bought it because they thought it was undervalued. They ran spreadsheets. They calculated industrial demand. They made rational decisions. At $50, silver was a speculation. Traders bought it because momentum was building. They saw the chart breaking out. They wanted to ride the wave. At $80, silver became a hedge. Institutions bought it because inflation was persistent. They needed diversification. They needed insurance. But at $100, silver is no longer any of those things. At $100, silver is a survival asset. And this is where traditional market analysis breaks down. Because survival assets do not obey normal supply and demand curves. They obey a different law, a psychological law. It is called the Giffen-Good paradox. In normal economics, when the price of something rises, demand falls. People buy less because it becomes too expensive. But Giffen goods are different. Giffen goods are goods where demand increases as price rises. Why? Because the rising price itself signals scarcity, panic, systemic failure. Think about it. When silver was $20, investors had time. They could wait for a dip. They could dollar cost average. They could be patient. But when silver hit $100 in a matter of weeks, the psychology changed. Suddenly, the question was not, is this a good investment? The question became, will I be able to buy this at all tomorrow? When people see an asset doubling in months, they do not think this is overvalued. They think the currency is dying. And that triggers a different instinct entirely. Not greed, fear. Fear is a more powerful motivator than greed. Greed makes you want more. Fear makes you act immediately. And right now, the global investment community is transitioning from greed to fear. They are not buying silver to get rich. They are buying silver because they believe the system is breaking. And that creates a feedback loop. The higher the price goes, the more people panic, the more they buy. The higher the price goes. This is not speculation anymore. This is a stampede. Now let us project forward. If the government shuts down on January 31st, if the Federal Reserve goes dark on economic data, if the liquidity freeze we discussed in part 2 actually materializes, what happens to the velocity? Based on the current trend, based on the exponential pattern we are seeing, the next $10 move from $100 to $110 could happen in 3 to 5 days. Not weeks, days. And here's the truly alarming part. There is no resistance between $100 and $150. None. Why? Because no one has ever sold silver at those levels before. There is no historical memory, no psychological anchors, no chart patterns to reference. It is uncharted territory. It is what traders call blue sky. And in blue sky conditions, price discovery becomes violent. The algorithms have no data to reference. The market makers have no precedent. So the price simply jumps. We are looking at $110 by next weekend, $150 by mid-February. And if the liquidity crisis deepens, if the banking system shows cracks, $200 is not a ceiling. It is a waypoint. Because at that point, the question will no longer be, how high can silver go? The question will be, can you even buy it? But while silver is achieving escape velocity, there is something happening beneath the surface of the financial system, something in the plumbing, something that suggests the stock market is about to experience a heart attack. We need to examine the banking system. We need to look at the spread that predicts crashes. There's a moment in every financial crisis, a moment that historians will later call the turning point. But in real time, no one recognizes it. It does not announce itself with sirens or flashing lights. It happens quietly. In the back office of a bank, in a phone call between two traders, in a spreadsheet that suddenly does not balance, the moment when institutions stop trusting each other. And we are watching that moment unfold right now. Let us go deep into the machinery, beneath the stock tickers and the headlines, beneath the tweets and the political theater. There is a network of relationships that holds the entire financial system together. Banks lending to other banks, hedge funds borrowing from prime brokers, corporations refinancing debt with institutional investors. This network runs on one thing, and one thing only: trust. The belief that if I lend you money today, you will pay me back tomorrow. But when that trust breaks, when counterparties start questioning each other's solvency, the system does not slow down. It stops instantly. There's a technical indicator that measures this trust. It is not on CNBC. It is not discussed in earnings calls. But every risk manager at every major institution watches it obsessively. It is called the SOFR-IORB spread. Let us break this down. SOFR, the secured overnight financing rate. This is what banks charge each other to borrow cash overnight, using U.S. Treasury bonds as collateral. It is the real market rate, the rate determined by supply and demand. IORB, interest on reserve balances. This is what the Federal Reserve pays banks to park their money at the central bank. It is the artificial rate, the rate set by policy. In a healthy system, these two rates move in lockstep. If the Fed pays 5%, the private market charges 5%. The spread between them should be zero or negligible. But right now, the spread is widening. SOFR is rising significantly above IORB, and that is a 5-alarm fire. What does this mean in plain language? It means private banks are saying, I do not care what the Federal Reserve promises to pay me. I do not trust the collateral you are offering. I do not trust that you will be solvent tomorrow. So I am going to charge you more, or I'm not going to lend to you at all. This is the definition of a liquidity freeze, when banks hoard cash instead of lending it, when the pipes of the financial system clog. Now, why does this matter to stocks? Because the entire stock market, the S&P 500, the NASDAQ, and the Magnificent Seven, all of it is built on leverage. Hedge funds do not buy $100 million of Tesla stock with $100 million of cash. They buy it with $20 million of cash and $80 million borrowed overnight in the repo market. When SOFR spikes, when the cost of that overnight borrowing doubles or triples, the math breaks. The margin clerk calls. And the fund is forced to sell, not because the stocks are bad, not because the companies are failing, but because they cannot afford to hold the position anymore. This is what caused the crash of 2008. This is what caused the flash crash of 2020. And this is what is building right now in January 2026. We are seeing the exact same pattern. Softer decoupling from IORB, repo rates spiking, banks refusing to lend, and all of this 6 days before the government shuts down, 6 days before the data goes dark, 6 days before the Federal Reserve loses its ability to see what is happening. Let us talk about what happens when the liquidity freeze hits. First, stocks fall, but not slowly, not in an orderly correction, violently, because algorithmic trading systems are programmed to sell when volatility spikes. When the VIX, the fear index, crosses certain thresholds, trillions of dollars of assets are automatically liquidated. No human decision required. The machines do it, and the machines do not care about fundamentals. They care about risk parameters. Second, bonds fall, which should not happen. In a normal crisis, investors sell stocks and buy bonds. It is called the flight to safety. But this time, the bonds themselves are the problem, because the US government is the one shutting down. The US Treasury is the one facing a debt ceiling crisis. So where is the safety? There is none. Not in stocks, not in bonds, not in cash, because the Fed is about to print. Third, corporate credit markets freeze. Companies that need to refinance debt cannot. Investment-grade corporations suddenly find themselves shut out, not because their businesses are failing, but because lenders have disappeared. The maturity wall we have been warning about, $4 trillion of corporate debt maturing in 2026 and 2027, becomes an execution wall. Companies that cannot refinance default. Companies that default lay off workers. Workers who lose jobs stop spending. The economy contracts, and the Federal Reserve still has no data to measure any of it. Now, here is the critical insight for business owners watching this. You need to understand that this crisis does not discriminate. It does not matter if your company is profitable. It does not matter if your balance sheet is clean. When liquidity freezes, everyone suffers. Your suppliers demand cash up front. Your customers delay payments. Your bank tightens your credit line. Your ability to operate, even a healthy business, becomes constrained. This is not about being smart or prepared. This is about being in a system that is breaking. So what is the strategic response? How do you navigate a liquidity freeze as an entrepreneur, as a business leader, as an investor? First, preserve cash. This is not the time to expand aggressively. This is the time to build reserves, cut unnecessary expenses, delay capital expenditures, hoard liquidity, because in the weeks ahead, cash will be the most valuable asset you have. Second, diversify out of pure dollar exposure. This does not mean abandon the dollar entirely, but it means recognizing that the Federal Reserve is about to choose inflation over stability. Hold some assets that are not dependent on government solvency, physical gold, physical silver, assets that have no counterparty risk. Third, prepare for volatility. The next 30 days will be chaotic. Prices will swing wildly. Headlines will be alarming. Do not make emotional decisions. Do not panic sell. Do not chase rallies. Stick to your strategy. And if you do not have a strategy, get one. Now, let us bring this full circle. We started this analysis with a simple observation. Silver crossed $100. But that was not just a price milestone. It was a signal that the market has lost faith in the system, a signal that institutions are fleeing paper and seeking physical, a signal that the liquidity freeze has already begun. The government will shut down in 6 days. The Federal Reserve will fly blind. The banking system will hoard cash. The stock market will crack. And silver will continue to rise. Not because of speculation, not because of hype, but because it is one of the only assets left that requires no trust, no government promise, no central bank guarantee. It simply exists. The target of $500 is not a fantasy. It is not hyperbole. It is a mathematical outcome of a system in failure. When trust collapses, when liquidity freezes, when currencies are debased, hard assets do not just rise, they explode. We are not predicting the future. We are reading the instruments, and every single gauge is flashing red. The silent alarm is ringing. The question is not whether you hear it. The question is, what will you do about it? This is John Analyst. The countdown has begun. The liquidity freeze is here, and the exit doors are closing.